Make large crypto trades with Kraken OTC, execute orders of more than 100,000 off the open exchange through our premium OTC trading service. Get 24/7 access to deep liquidity, minimal slippage, and competitive execution and settlement services. Private and secure trading options include chatting securely with our trade desk for a personalized high-touch service, or use our self-service RFQ for super fast, automated OTC trading. Non-investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. For more information, go to realvision.com/Kraken OTC.
Hey everyone, look, sorry, this is the cheesy interruption that you get on YouTube channels, but they're really important. I'd really appreciate it if you just hit the subscribe button. You see, it makes a difference to know how I'm doing, seeing the growth in subscribers, if we're getting the right content. Obviously, comments help as well. But hitting the subscribe button allows me also to book the best guests. It really does make a difference. So if you do enjoy this content, and I know you do because you keep coming back to watch it, just please hit the subscribe button. Sorry again for the cheese, but it is important. I appreciate it so much. Take care.
Hello, everybody. Do not worry. Raoul will be with us in just a second. I just wanted to give a brief disclaimer that although our guest this week is a managing partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. Now on to the show.
Hi, I'm Raoul, and welcome to my show, The Journeyman. This is where we go on that journey to explore the nexus of the exponential age, macro, and crypto. Now, many of you know I've been in the hedge fund industry for 30 odd years. At first, I used to speak to the biggest hedge funds in the world and advise them. That was my role at Goldman Sachs, where I ran that business, advising the world's largest hedge funds and obviously executing their trades. Then I moved across to one of the largest hedge funds in the world, GLG Partners, where I started and ran the global macro hedge fund. Back in 2004, I opted out of the rat race, moved to the Mediterranean coast of Spain for quality of life, and that's where I started Global Macro Investor, my kind of premium research service that I write today, 20 years later. And that, again, is read and aimed at the world's biggest hedge funds, sovereign wealth funds, family offices, high net worth individuals. The hedge funds have been my lifeblood. I speak their language. I live that world. Many of them are my friends. One of the reasons I also built a business around this called Exponential Age Asset Management is because I think hedge funds offer the great opportunity to capture the alpha in markets. You see, the crypto markets are going to go from, I think, $2 trillion where they are today to something like 100 trillion by maybe 2032. That's an enormous rise, and we won't capture it all by just focusing on Bitcoin, Solana, and Ethereum. We need to be able to move further out the risk curve, but that's bloody hard. It's not something I can do. This is what hedge funds are really good at. They do this. They spend all of their time looking for alpha, looking for opportunities. So I find speaking to hedge funds super rewarding because these guys have capital on the line. They not only have their own personal capital, they also have investor capital. So their job is to focus on the best opportunities in a risk-adjusted return basis. And, you know, again, this is at Xpan, what we do is we allocate to 14 of the world's best hedge funds. Now, the hedge fund I'm speaking to now, Multicoin. Now, as a disclosure, we are investors in Multicoin, but they're one of the most famous investors in this space. And I think we would all really benefit from sitting down with Tushar and finding out how he thinks about the investment opportunity in crypto and where it is going forwards. I hope you enjoy this. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Tushar, fantastic to get you on Real Vision.
Oh, thank you for having me. It's great to be here.
So, as ever, before we kind of get into what you do today, I always like to hear people's stories. How to get into crypto? What's your kind of journey up to where you are today?
Yeah, happy to give a brief overview. I grew up in New York. I thought I wanted to work in finance. I went to NYU, studied finance. Thought I was going to be a banker. Decided I did not like that very much at all. Tried it out for a summer, and I knew it wasn't for me. So I moved to Austin from New York to work at a startup. That startup didn't end up working out, so I left about a year in, started my own company in healthcare IT, where I worked for about 4 years. We raised some venture money and had a pretty compelling product. But when I saw crypto, I got really excited. I first heard about Bitcoin in 2013, and I bought a couple, literally just 2. I wish I had bought more. Everyone wishes they had bought more back then. But Bitcoin wasn't for me at the time because it was all about hard money and Austrian economics and some of these things that, while I understand and appreciate, are not what I identify with. What got me really excited was in 2016, I saw Ethereum, and Ethereum showed me how you could use blockchain technology to coordinate people, to build products and do things that they couldn't otherwise have done. And to me, I love history. I love economic history and political history. And this immediately reminded me of the creation of the joint stock corporation, or the LLC, where, before that, you just couldn't have businesses that got all that big because you could only be in business with your family members because everything is a general partnership and you're liable for everything anyone does. And then as soon as you could reward employees with shares and as soon as you could have limited liability, it's just this huge social technology unlock. And that's what I saw in Ethereum in 2016. Quickly grew obsessed with it. Kyle and I had gone to school together. We were friends for a long time. We were roommates for a long time. And he had also gotten very obsessed with it. So in May of 2017, we decided to launch Multicoin. You'll notice from the name, this was a time when the debate was, will there be one coin to rule them all, Bitcoin, or will there be many coins? And we're like, we believe so much that there will be many coins, we're going to put it in the name.
But what the hell did you know about running a crypto hedge fund or investment manager when you were healthcare IT? I mean, what gave you the crazy idea to do this?
That's a great question. I ask myself that question all the time. I knew nothing other than I knew that the industry needed professional investors who were thoughtful and who were going to be deliberate and had the ability to bring traditional valuation frameworks to mind and had this multidisciplinary approach to understanding what is this new thing, right? Like I had the finance background, I had the technology background, I had the history and political science and economics background. Not all of these are formal. Some of these are just interests. But like if you're obsessed with something and read enough about it, like, something. And like this was the combination of all of those things that I was interested in. So I thought, let's start publishing what we think about on the internet and, see what happens. And so we launched our fund on October 1st of 2017 with about $2 million. It was our combined life savings as well as some investors that we brought on that had invested in our previous companies.
Nothing like launching at the peak of a bull market. I did that with XPAM. We launched December 2021. I mean,
oh man, yeah, it is difficult. Yeah, we had a couple of good months of performance there at the end of 2017 before the 2018 bear market hit, but thankfully we were able to bring on some really great LPs throughout that bear market. And a lot of it was because we wrote a lot and published a lot about how we thought about things and gave differentiated opinions to the market.
So before we dig into that process and how your thinking has evolved over time, what did it feel like launching with your great idea, having your life savings in, the market exploding higher for 2 months and then collapsing for an entire year after that? Did you start thinking, oh man, what have I done? Or did you kind of understood the cycle and how this works?
It was awful.
That's an honest answer.
Yeah, it was really awful. Definitely doubted my conviction, but stuck to it. And this is a time when actually having 2 managing partners, 2 co-founders really helped.
Yeah.
Because you can lean on each other. It's easy as a solo decision maker to let bias take over or your emotions. Like, we're all humans, and you have to be honest with yourself. So Kyle helped me a lot during that time, and I helped Kyle a lot during that time.
I mean, you cried a lot together on calls.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future. What was your process by which you approached the space? Because, as it says, the name is on the tin, you were Multicoin, so you believed in a vision. What was your vision? And then how did you evaluate things using that kind of framework?
So our vision was that crypto or blockchains at their heart are a coordination technology. They are meant to be used to help people coordinate together and align incentives in order to deliver commercially useful products. And that's always what we look for, is protocols where they're doing something that otherwise would not have been possible. So DeFi is an interesting example of that. Or dPIN is another really interesting example of that. These are creating useful products for the real world. Stablecoins, another useful product for the real world that would not be possible without the accounting ledger, the coordination technology that is a blockchain. So that was our fundamental thesis from the very beginning. And then we looked for different instantiations of that thesis where we could go and apply it. And then we had a number of follow-on criteria for investments because obviously entry price really matters. Obviously, what does value capture look like really matters, right? Like, we're venture capitalists, not venture philanthropists. So we are looking for things that can earn a profit and make a return for us and our investors. So we looked at a number of token economic designs. I think that was one of the areas where we really focused. A lot of people at the time, especially in the early days, were betting on founders. They were betting on people because they're like, this sounds really good. They're betting on ideas. And we did a lot of work on things like the token velocity problem and like how you should design a token and how you should not design a token, what tokens will capture value, what tokens won't capture value, because the economics of protocols are very different than the economics of companies.
And did you start primarily as a VC, or were you both liquid and VC? How's the evolution of how you managed capital evolved?
We started with the hedge fund. So we started with liquid markets because when we started, we were so early, there were no private markets. It didn't exist. It was you ICO and you go, and everything was done in public markets. So there was no need for, long duration locked up capital, and liquidity, allowed you to have an open-ended hedge fund structure. But then in 2018, we launched our first venture fund because then we saw the evolution of private markets. We were doing some venture type deals out of the hedge fund and putting them into side pockets at the time. But we realized that that wasn't necessarily the best structure for a whole variety of reasons, and that it would be better for our LPs if we created a venture fund. And so we launched our venture fund in the summer of 2018.
And if you look back at the two, where's the performance come from? Has it been mainly VC because of the ability to have the liquid tokens as part of it? I mean, do you do equity as well? And how's that compared to the liquid market side? Because I've got a thesis that VC's done very well, but now there's a lot more capital in it. As you know, I've obviously got the asset management firm Xpan, and we're investors in you guys. My thesis is that liquid may do better over a period of time because there's less competition in that area. How are you thinking through, and how has it worked since then?
That's a great question. So let me play it through time and how it's changed.
Yeah.
At the beginning in 2017, that was the beginning for us. It was just public markets. There were no private markets, so not really a question of what to do. But then in 2018, we started to see the emergence of private markets, of entrepreneurs realizing that VCs are actually helpful, and you need that capital and you need that expertise, and you can't just go do an ICO and think that the public will support you in the same way that a dedicated VC will. But there was very little capital in the venture market at that time. All the way through about 2020, there was basically no capital in the for venture. Our first venture fund was $17 million, right? So given how much we manage today, it's amazing to look back at like that. And that was difficult for us to raise at the time.
Yeah, I was about to say, that's not bad considering how bad the market was and how nascent it was.
Yeah, but the amount of doors we had to knock on, and that, you just you do what you need to do in order to make it happen. But at that time, there was a lot more capital in public markets, but it was pretty concentrated in the big names. It was Bitcoin and kind of Ethereum, and that was about it at the time. And then we started to see, some really fantastic venture returns for us and some other venture investors in the space. And so what we have seen since 2020 to now, I would say it's kind of flipped. And there is far more capital on the venture side now than there is on the public market side. In 2021, this was all disguised and didn't really matter because global glut of liquidity, numbers could only go up at that time, right? And everyone was pretty irrational, including us and everyone, right? But now we're seeing that with all of these tokens being launched, all these new projects going public, quote unquote, and there's very little competition in the public markets. There's, a lot of interesting opportunity there. Whereas on the venture side, there's, a lot more capital chasing fewer deals. And one of the most important determinants of returns is how much competition do you have. If you have a ton of competition, your entry valuations won't be great. And then, it's really hard to make exceptional returns.
I was speaking to Richard Galvin from DACM recently, another fund we're invested in, and he raised a really interesting point. He's like, the markets are so skewed now because of the size of the VC, because of 60 billion went in back in 2021, 22, and there's only 10 billion in liquid hedge fund space. He said, so what he's seeing is as tokens come onto the market, because there's a future unlock of, whether people unlock them or not, the market tries to discount it. So you tend to get these massive drawdowns, allowing the liquid guys to get into really good projects at really quite significant discounts these days. And so he said, that overhang has actually created great dynamics if you're brave enough in the early stage of a token coming to market when it plummets in price.
Yeah, that's absolutely the case. You have to know what you're doing, right? You have to truly understand what is it that you're buying. Who else is there around the table with you? What are their motivations? Right? Like there's a whole variety of people in the industry. And I think it's important to choose who you're in business with. And I think the market does overreact to things like token unlocks. And that irrationality presents a buying opportunity for sure.
So let's go back a bit. So you've launched the VC fund and you get to, let's say, the bottom of the bear market in 2018, 2019. How do you then start raising capital and raising your conviction levels and start to try and deploy? Talk me through that process, because people struggle with that, right? A lot of people get PTSD from the down markets. I've taught myself to look forward to them because you can add capital and you compound your returns, but that takes a few goes at that before you understand it. How did you deal with that process?
We would always go back to our fundamental convictions of this is a technology that is the internet native means of capital formation. I would consider, the joint stock corporation or limited liability company to be the printing press native means of coordination. And we just had this new thing called the internet. It was changing everything. And I knew that the way that we organize with each other as people and as businesses and institutions was going to change. And I knew that we just had to find what the right ways that was going to evolve were that we could invest in, but it was going to take decades. We never thought it was just going to happen all at once. And along the way, there were some signs of hope. It wasn't just bleak, hopeless bear market. There were some good things that happened too. At the end of 2018, November 2018 was like an awful time. The price of Bitcoin dropped by like 50% that month. But then in December, we found this asset called BNB, which we found really interesting. And we published a research report on it in January of 2019. And we, built a significant position in BNB in our hedge fund because it was all public liquid market stuff. We didn't ever do a deal directly with the company. And we published this report and we saw, Binance just out executing everybody at the time. And, you can look back at the charts from then, but the returns from BNB that year were fantastic and they carried us at the time. And, it feels good to get a win. Like you can't just keep getting L's and keep going. It feels good to get a W in there. And like that was a very motivating W for us.
Now, one of the things that, I too was class of 2013 with Bitcoin. One of the things that I saw in it immediately was the game changer in terms of both capital formation and kind of aggregation of interest of people is the behavioral economics side of this thing. Because, you bring people into a network and the token value goes up because of Metcalfe's law, increases the value of the network. And that allows you to bootstrap businesses really fast. And I still think that hasn't been fully yet understood by people in what that means. Yes, we see some perverse incentives now, airdrops or sort of ways of farming it. But I think the ICO thing was the start of something much bigger, but we've got to get back there again. How do you think about the ICO in terms of capital formation, speed of spinning up businesses, or capital destruction, which is important as well, for bad projects can just die fast? How do you think about it?
I think we have a big problem right now. And the big problem is that there is a philosophical misalignment between what the venture crypto community thinks and what the liquid crypto community thinks. The venture crypto community thinks that long lockups signal incentive alignment and that this is a good thing for you to do because it shows that you're around for long term. You're not in it to make a quick buck. You're not going to flip the thing. But the liquid crypto markets think low float, high FDV projects are really hard to invest in because you don't have price discovery when you have a 3% float, right? Like that's the number. You might see a number on the screen, but that number is not actually what the asset is worth. You have a 3% float, and so you have this disconnect. And I agree with you that, we need to go back to some of the things from the era of ICOs, not all of the things, obviously. There were a lot of excesses and bad things too. But, what I think we need is actually higher floats. And now how do we get there? I think we actually have a template. There was one entrepreneur that we worked with who really thought about this differently. Everyone else thought about it like a typical venture investor and said, long lockups is the way to do it. There was one founder who thought differently, and that was Anatoly from Solana, where he put together a 9-month cliff for all tokens, all the team, investor tokens, everything vested on a 9-month cliff. And I remember because we led every private round in Solana, before they launched, and we were significant shareholders. We had a ton of conviction there. And I remember when he told me this, I thought he was crazy. I was like, no one does it this way. But then he talked me through his logic, and I was like, okay, I understand, why you're making the decision that you're making. And I don't know if you remember what it was like going into 2021, like towards the end of 2020, December 2020, the amount of Solana FUD on the timeline was unreal. It was just like people showing the chart of the unlock and how everything's going to be awful. and a bunch of Ethereum people dunking on Solana, saying, hey, VCs are going to sell everything, like get out now. And obviously we know how that all turned out afterwards. And I think the reason for it was actually because he didn't play the low float, high FDV game. He said, no, the tokens are out there. Let's get to price discovery. If there's going to be pain from people selling, do it now. Let's get it behind us and let's give public markets price discovery. And I think that's a really phenomenal case study of how I think other founders should also approach engaging with public crypto capital markets.
I've also been thinking through these low float tokens, and one thing that I think firstly is now the market discounts them, so therefore you get a good shot in the liquid markets to make a decision, because the decision I think you've got to make is the supply is known, so that's off the table. In typical markets, unknown supply, unknown demand, that's complicated. Known demand, not known supply, you can model something, and the reverse side. So I look at these and I know what the supply is going to be because we've now got the unlocks. The tokens have been discounted because low supply. And then what you know is, well, if demand does come, the beta of a low float is gigantic. And I think it's going to crush everybody's understanding of what low float means in this bull market, and they'll all be wrong. And they'll be wrong because limited float, but good demand, because some of these are really great projects, will create really asymmetric risk rewards. I don't think anybody understands this because they think future token unlocks always mean the price under pressure. Yeah, in a bear market, they'll probably go down more than others. But in a bull market phase with a very small float, I think this is very interesting. And I guess they're all going to outperform.
I partially agree. I think what you're saying is true for a good number of high quality projects.
Yeah.
But I think we're going to see...
That's the caveat. These are ones that actually get demand because they build network effects and adoption, stuff like that. If they don't, then no, it's going to shit.
Yeah, there's a lot of tokens that are out there that I would say are basically memes, and maybe not explicitly or deliberately, but that's how they trade.
Yeah.
And I think we are finally entering the level of market maturity in crypto where we see a huge dispersion in returns based on asset quality. In the past, you look at the 2017 bull market. I mean, I remember like everything ripped, right? It didn't matter what it was or if it was useful. I remember in December 2017, if you owned any alts, you were just waiting for your number to get called. And, that was a day that you should sell because the thing was up 200% in a day for no reason. I remember in 2021.
Can we have those days back again, please?
And then in 2021, it was kind of similar too, right? Like you own some NFTs or you own some, other high beta asset, and you just waited for the day that your number was called, and you saw the thing rip up 200% in a day, and you're like, oh my God, this is amazing. I must be a genius. As much as we may want those days back, I don't think they're coming back. I think we're going to see much more sophistication and much more pickiness from public market allocators in crypto. I don't think they're going to be indiscriminately bidding across the board.
But I'm going to see how my thesis gets tested. But my guess is the ones that win, the early stage ones that win this cycle of the quality projects, like Solana was last time or ETH was the time before, will all be low float. Maybe there's one that isn't, but it's just very hard to beat a low float, because I've seen this in markets themselves, in traditional markets. You've got low float equity. You bring in one large buyer, it goes bananas. So how do you think about, you said when your number comes up, how do you think about the cycle? Do you think about the cycle? Do you trade accordingly? How do you exit positions and how do you enter positions? Because these are things that people get wrong. I do use the cycle, but really for entries, and then tend to just hold over longer time periods and maybe switch assets in between. But how do you think about it?
I know that I'm not a trader. I know that I'm not going to be able to time market bottoms and market tops. I talked to a lot of other investors, managers, and I ask them, do you have a systematic strategy for timing market cycles? And almost always they say no. All right. Then I ask them, do you think discretionarily you can outperform by just making a discretionary decision about this is a market top or bottom? And they usually say no. And so I'm like, okay, well, you can't do it systematically and you can't do it discretionarily. So why are you doing it? And the reason why a lot of people do it is they want to dampen volatility. They think that, that is a good in and of itself, which is fair, right? Like people have different preferences, but if you're worried about dampening volatility, I think just lower your bet size is actually a much cleaner way to express that. Because when you try to trade beta, the worst thing that can happen to you is you get whipsawed, where you're like, oh, this is up, 3x. I think it's fantastic. I'm going to sell. You sell it. It goes up another 10x from there. And you're like, oh my God, I'm missing out. I need to be back in. You buy back in, and that was the top. And that is such a common market pattern for people who try to time tops and bottoms that, I suffered that pain, and I was like, I'm never doing that again. I don't want to feel that pain again. So the way that I think about it is, our objective is to outperform across market cycles, not within a market cycle. And whenever we have an investor, like I think of it as, we'll put the money into Bitcoin and then we are underwriting other investments in Bitcoin terms from there. So that's what we think of as the bellwether that we want to outperform. And if we want to buy something, we have to think it's going to do better than Bitcoin over some time horizon. And then when will we exit it? We'll exit when, it's either one of three things has happened. Either one, the thesis has fully played out, or two, the market has gotten irrational and now overvalues it, or three, we like something else better. And so, this still might have a lot of potential, but like this new thing just came across and like, I love it so much. I want to put, more capital in that direction. So those are three reasons why we would sell.
How I thought of the space, and one of the reasons I set up XPAM was, I just put it really simple terms. The space today is $2 trillion. I think it's going to $100 trillion. That's just the extrapolation of market cap or the log regression channel of the price of Bitcoin. You can kind of back it out in a number of different ways. And maybe I'm an idiot, wrong by 50%. It goes to 50 trillion by 2032, 2034, something like that. And so the job, therefore, is to ride that trend. It's not, because one thing that people don't understand is it will not be a $50 trillion Bitcoin world. Bitcoin might be 10 trillion. Well, there's going to be 40 or 90 trillion of value created somewhere else. And that's what hedge funds can do, because that's a hard job. You need to be super focused to think, where is the really big value accrual? Like you did with Solana. Classic example is you see something really early stage and the value accrual has been vast from that and it's not over. And that's what I think the bigger opportunity. If people zoom out, stop worrying about the cycles as much and just think, how do I capture that trend? Because I think that is the largest, fastest accumulation of wealth in all human history if that plays out.
100% agreed. And I agree with your ratios as well, because the analogy I would draw is, let's look at, traditional markets. Gold is what percentage of total wealth, right? It's a small minority of total wealth. Actually, most global wealth is in global equities and real estate and other real productive assets. Yes, we do need financial assets in order to make the economy function. But financial assets should always be a minority compared to actual productive assets. And to me, Bitcoin is going to be enormously valuable, is already enormously valuable. I think it's going to be far more valuable than it is today. But to me, that is a financial asset. Bitcoin is not a productive asset. You can't do stuff with it. It doesn't generate cash flows. It doesn't have a business model behind it. It's just an asset. Whereas when I look at something like a Solana or a Helium or some of these other projects in which we're investors, these are productive assets. They are businesses that deliver a product that consumers are willing to pay for, and they're just a new way of building that business. It's not an LLC somewhere. And I think that that's going to be a much bigger part of total market cap looking a decade out than the non-productive assets.
Yeah, I kind of think if we're building a parallel financial system is probably too small an expression for what we're building. But let's call it the future of the internet, the future of money and value and all of that. Then it cannot be that the collateral of the system is the most valuable thing. It might be valuable in terms of you need it, but it can't be valued more than the system. If not, you don't have a system. You, in fact, probably have the apocalypse. And it's kind of, there's a health ratio here where you need, as you say, these productive assets to be worth significantly more than the collateral of a system. If not, just nothing works. So how do you, when you look at the space now, what is interesting to you from like a core holdings perspective, where your view is on ETH versus Solana and some of that, and then we'll get into what excites you for the future. But, if you're looking across the broad 3, 4, 5, 6 assets, however you want to measure it, what do you think? How should we think about those? Because narratives keep shifting, as you know. They're not necessarily accurate either.
So let's start with the ETH Sol question first, and then we'll get into some of the subsequent questions. I think that Solana is gradually flipping ETH on every metric that matters. We're seeing that this year, metric after metric, total transaction fees, total, trading volume, active users, all of these things we're seeing flipping, maybe not, holding the number one position, but getting there, coming back and trading back and forth. Yet these assets are priced very differently. And I think Ethereum is in a really, really tough spot right now because in one direction, they're influenced by Bitcoin and they want to be like Bitcoin. They want to be this World War III proof kind of maximally decentralized thing, but they're never going to be as decentralized as Bitcoin. It's just the laws of physics prohibit it, right? There's just more state in the system. The laws of physics literally prohibit it being as decentralized. And then on the other side, they want, Ethereum wants to support DeFi and it wants to support payments and it wants to support NFTs and it wants to support all of these wonderful things that people want to build on these rails. But it can't compete with Solana on that side. It's because it's trying to also be Bitcoin on the other side. And, it's kind of in the middle of the barbell. So in terms of big liquid assets, I think a barbell of Bitcoin and Sol is the most effective portfolio construction because you get the best of breed of both, right? Bitcoin is your bellwether asset. It's the asset that's maximally decentralized. It's the asset that's most widely distributed. And nothing will ever change about Bitcoin. And then Sol is the extremely high performance asset that wants to be the base layer for all of the other stuff and isn't compromising that vision in order to try to compete with Bitcoin. It says, let Bitcoin be Bitcoin, and we're going to go build a decentralized computer. And ETH is kind of stuck in the middle. I think ETH has been outsourcing a lot of its value capture to its L2s because they're the ones who are actually doing the execution on all of the transactions that are happening. And I think that's the actually valuable part, is coordinating state. I don't think the valuable part is the data availability layer or the settlement layer. I don't even know what that actually means. So I think simplicity is key, and that's why I like Bitcoin and Sol as kind of the barbell of the top big assets.
Yeah, I mean, I don't disagree, although I'm almost 100% Sol still currently. But for me, I've been thinking through this layer 2 versus ETH, and I'm not sure the market's got this right yet. I think people think they're parasitic because you take activity and you only use a small amount of the underlying ETH. But I think ETH is valued, and why ETH is more valuable currently than Solana is because it's valued via Metcalfe's law, the network value, and the L2s are included in the total value transacted. And if you look at the number of applications built on Ethereum, it's still larger. When you take into account the layer 2s, the activity is still vibrant. So I'm not entirely sure we yet know, and I could be dead wrong here as well, but how to value this or what the market's actually telling us yet. Because I think markets are actually quite efficient at pricing this stuff. But either Ethereum really starts sinking from here, which it's been doing over the last few months versus others, or we're not fully understanding what is being built. Because I think we all believe in this multi-chain world. So it's just, the pie grows. So it's not like one necessarily versus the other. What do you think about that? Think about the layer twos in the value accretion. Where does the value accrete? I mean, because we've also seen the base has shown we don't even need a token for a layer two, which is another interesting thing.
So I gave a presentation at our LP Summit in 2022. The video is up on our website at multicoin.capital and on our YouTube. And the title of that presentation was MEV as a valuation framework for valuing asset ledgers. That means L1s and L2s. It's a short video. I don't think I can do it justice by going through, the 15-minute explanation right now. But the 60-second version of it would be that MEV is unavoidable. Someone's going to make the arbitrage profits. The question is, who gets to make those profits? And I think in the realities of a permissionless blockchain, it's whoever gets to sequence the transactions is going to make those profits, either by collecting large priority fees or tips or whatever you want to call it. I think whoever sequences the transactions gets to decide who gets the arbitrage, and therefore they get to earn the profit. And that's why I think as one component of a valuation framework for asset ledgers, L1s and L2s, you have to look at your discounted cash flow value of all of the future MEV that you believe that asset ledger will have. And you can talk about discount rates and all that stuff all day, but you pull that to the present, and that should give you one component of what I would think is a sum of the parts valuation for one of these asset ledgers. And what Ethereum did is it basically took that part out, right? I think there's the sum of the parts is a 3-part valuation framework. One is this cash flow component, the discounted cash flow of future MEV. The second is a commodity component. This is the EIP 1559 type, some ETH is burned and some ETH is minted. And what does that ratio look like? And is it deflationary or inflationary right now? And then the third is a moneyness aspect. And the third one is the most vague, hardest to define. There's no quantifiable thing. This thing is this money versus that money. That's hard to say. So it's hard to put that into your valuation framework in a quantitative way. So I think of those three, ETH sacrificed one. It said, we're not going to have the MEV. We're going to push all the sequencing off, and someone else will make that money. And so it cut off one of the legs of the three-legged stool. And then when it comes to being money, right, like in decentralized gold, in a sense, I think it's an uphill battle, right? Like I think that is very much it's almost a religious battle, right? Because what is money is just what do we believe is money?
It's just a mimetic that is commonly held amongst the largest group of people. I mean, that's basically it.
Exactly. And Bitcoin has the best story for that. You have Satoshi, being the prophet, delivering this thing for the rest of us and then disappearing. No one owns it, too much of it. It's all super well distributed. It was first. Like Bitcoin owns the money narrative in a way that it's very hard to compete with. I'm not saying that no one will compete with it, but it's really, really hard, right? And so the only leg of the stool that I think Ethereum really has left is the commodity aspect, the inflation versus deflation, the ETH burn piece. But at least, if you've been looking at it recently with the rise of L2s and, all the transactions happening there, ETH is actually back to being inflationary again. So, maybe it becomes deflationary as there's more usage. That's certainly possible. But I think they lost the MEV leg of the stool, the cash flow leg of the stool. The money leg of the stool, I think, is really tough. And then the commodity leg of the stool is not looking super strong.
Yeah, the only way to solve this is a massive increase in scale of use.
Correct.
Because then the low fees don't matter because it's made up by volume. If you get a lot of volume, you get deflationary token economics. But in this world where currently we don't have enough use for all of the block space available across the ecosystem, it becomes an issue.
Yeah, so let's talk about that. What can we do to get more use, right? I have a theory here, a thesis that I've been working towards. And my theory is that we have effectively tapped out the number of people in the world who will go through an onboarding process to put money on chain in order to make a profit. Right now, the people who come on chain are coming on because they want to use some asset for financial purposes. They're not coming on for pure utility purposes, right? They're coming on like, I want, I want to go make an investment that's going to make me money, right? Like and I think that's a minority of the human population. To you, to me, this seems like a natural thing. Like, of course I want to do things that make money. To our listeners today, like, it seems like a natural thing. Like, you think everyone thinks like that. But everyone doesn't think like that. I think we are a small, small minority of the global population. So what do we do to get new people on? And I think what we need to do is we need to give people funded wallets. They need to earn their wallets, their funded wallets with some asset, not buy a funded wallet. And there's two ways that I can see that happening right now. Number one is you see something like Web3 gaming really take off, and people can earn these assets by participating. Or two is dPIN, where people can earn assets by helping build a wireless telecom network or a decentralized virtual power plant or a mapping network or any number of these things, decentralized AI inference cluster, and you can earn tokens that way. And then you end up using DeFi, or you use those assets for payments because it's the fastest, cheapest, most convenient thing to do, not because you wanted to go through some onboarding process to, go and like speculate effectively. And like the one data point that I would bring up in order to back this up, Jupiter is one of the big protocols on Solana, big DeFi protocols. When they launched their token earlier this year, the Helium community did an analysis that showed that actually 10% of Jupiter's users had come from Helium and were just using Jupiter because it was the easiest, fastest thing for them to do. And that was 10% of the users of the DeFi, of the biggest DeFi thing on Solana, came from this one dPIN app. And so that's why I think that's the nut to crack. To get more users.
I totally agree, but the other hard part of this equation is to create a token economy where it's not all outflows, because you earn on one side and you transfer value on the other side. You've got a very leaky capital flight problem. And I've seen very few people solve that without the money recirculated. Then people need to figure out the token economics better. I don't think anybody's got it dead right yet.
I think the mechanisms are actually well understood. The problem is building something that has end user demand and has the type of revenue. Because, like burn mint equilibrium, whether that's how it's implemented on Ethereum or how it's implemented on Helium or, any of these networks, like it's fairly simple to model out. You have a token burn for using the product. You have a token emitted for helping provide the product. And then you find the equilibrium, right? It's not a super complex model. The problem is that there's very few things that have the demand side there to burn enough tokens to provide an equilibrium. And so, if your demand is here and your supply is here, like that's really not going to work very well. And that's the state that we're in, because it's just so early that a lot of these products, they haven't been able to deliver the smooth user experience. It's not a polished product for mainstream in a lot of cases yet. And you need that before you can make the revenue to make this sustainable.
I also think that outside of the behavioral incentive system that comes inherent with blockchains or tokens, I think there's just simple things like, if you just step back and say, what is an NFT? It's a non-fungible smart contract, essentially. And then you start thinking about where the opportunities might lie. And I just think obvious things are ticketing. And I've talked about this a lot. I'm like, this is at scale, something that can be very useful for every participant in an ecosystem, music, sports, everything else. And these things can maintain value if you go to that amazing concert, that great game. You've got secondary value of which tickets really don't have in the same way, and tradability. And that same thing can apply to hotel rooms. It can apply to airline tickets, Airbnbs. It can do so many things, and you wouldn't even know it's an NFT. It's just like your Ticketmaster thing is in a digital wallet anyway. Why do you care?
Yeah, just like the internet, where in the 1990s, you had all these great ideas that the companies ended up failing because it was just too early and the infrastructure wasn't ready. I think ticketing is one of those. We have our own scars from that. We've invested in a number of ticketing things that did not work out. But I think the thesis is still fundamentally valid. I agree with everything you said. And just because Webvan didn't work out in the 90s doesn't mean that DoorDash won't work, now. And I think the difference was that you need broadband. You need mobile, you need the cloud, you need all of these different pieces to put together in order to be able to deliver that product. So for the case of ticketing, you need a high throughput chain that doesn't go down and is super reliable and is super easy, and you're not figuring out like, oh, am I pointing to this L2 or this L1 or do I need to bridge? Users don't want to think about any of that. Users just want to scan their ticket. They just want to say like, here, and then, go on their merry way.
And the Solana compression for NFTs, I think, is showing us the way. It's possible now to do cheaper than printing a physical ticket. So in which case, I know most tickets are now being replaced by electronic tickets, but you can, for the same cost now, essentially you can have the extra benefits of all of this. So I think it's a matter of time. As you said, I think dPIN is interesting. DeFi continues. What's in terms of other ecosystems or things are getting your attention now? Yeah, we're at the stage in a bull market where it should broaden out into more alts and newer projects. What's getting your attention?
Those are the main things, honestly, is looking at different dPIN networks, looking at DeFi. I do think DeFi is a second horizon thing. I think we need to get more users with funded wallets before DeFi can really take off. I think that DeFi right now
It's not easy. It's not easy.
I'm a sophisticated user, and I sometimes struggle with all of the approvals and keeping track of everything. And I've sent more on-chain transactions than 99.9999% of people, right? Like they've truly sent an exceptional number of transactions, but it's still hard. So yeah, I think it just needs to be simpler. And I think you need to give people assets to trade with. They need to earn them. I fundamentally think we've run out of people that want to just put in money to speculate.
Do you think that, bizarrely, Worldcoin might be doing the right thing?
I think Worldcoin is fascinating.
I think so too. Now, whether they get this right or not, I love when a narrative is so wildly the opposite way. I'm like, it's interesting. Yeah, tell me, what do you think?
So let me share a theory with you. I have a theory that new crypto bull markets are kicked off by new methods of token distribution. So let me give you some data points. 2013 market that got your attention and got my attention originally, I think that was kicked off by the proliferation of proof of work forks. This is when people were like, oh, Bitcoin works. Like, let me go create another, coin. This is when like Litecoin and some of these things were created, right? That was a new method of token distribution. 2017 was ICOs. It was a new method of token distribution. People saw, oh, this works, and you get tokens out there. Then in 2020, you saw liquidity mining and DeFi. And that was a new method of token distribution, and that kicked off a DeFi summer and a big bull market. Then in 2021, we saw NFTs. And NFTs were like the new method of token distribution. You got all these celebrities coming in. You got a new cohort of participants because of a new method of distribution. And now, like, what I am looking for is I'm looking for that new method.
Well, we had
for this
memes.
cycle.
memes were like zero friction launching of zero utility. It's an interesting concept that's very early, and I think it'll morph into something more akin to whether it's fan tokens or social tokens or whatever. But yeah, so tell me what you think of the Worldcoin distribution model, because I mean, it's clunky and expensive and hard, but they've distributed a lot of tokens.
Yeah. My top 3 candidates for what will be the distribution mechanism for this cycle is one, what you just mentioned around meme coins, because it's getting new people in, and it's just fun and different. All right. People really like it. The second is dPIN, which we've talked about already. And then the third is something like a Worldcoin. And I think that there's some value to the meme of this was distributed out to everybody. Everyone has it. And they did a very smart thing where they don't just give you all of your Worldcoins up front. It's an ongoing drip. So you have to come back and you have to, get them again and again and again. And that way, even if you sell your first drop of Worldcoin, like you have more coming later. So if it becomes more valuable and more useful, or easier to, use for payments or anything else, then you don't have to go buy more in order to use it. Like you'll have it come to you.
That's fascinating. So you and I both bought Bitcoin early days, and, I don't know whether you sold yours out, whatever. But let's set this idea of you give people some, and then you give them a second bite of the cherry later is really interesting, because if it does go up in value, they kind of have this "I'm never going to sell that again" concept. Really behavioral. Because if you got given like $100 and now suddenly it's worth $1,000, and then you get your second distribution, you're like, oh, but this could be worth $1 million. You'll never sell it.
This is what helped Bitcoin, is all of those early Bitcoiners who sold, and then they saw the number, increase so dramatically beyond their wildest dreams. And now they buy and they're like, I will never, ever, ever sell any of this ever again. Right. And you saw the same thing with the Ethereum group and the DeFi group and the Solana group. Right. Like you have to see that it's almost like the human regret powers the holding ability of those people, of that community in the future. Like how much regret has this asset caused?
It makes sense, because you see the same with Amazon, you see it with Microsoft, you see, anybody who ever sold that stock has been proven out to be dumb and a terrible investor, because really all you had to do was hold it. That's why Bill Gates and Bezos and whatever are the richest people in the world, because they never sold their stock, or not until much later. So final question for you. What are you seeing in the VC side of your portfolio that is shifting your perspective to say, this is interesting that's coming, whether it's in line with the areas we've talked about or just people trying some crazy stuff?
The most interesting things I'm seeing are all revolving around like payments and dPIN and how to give people funded wallets. I know I'm a broken record on this, but like that's...
Yeah, I'm involved in one which is around wine, which is a $1 trillion industry. And it's the same thing, as you earn your tokens by actually scanning your drinking of a wine into the chain. You have these corks that are electronic corks, and that gives data back to the wine producers so they understand who's drinking it and what. It's fascinating. And it flows into global supply chains, stuff like that.
Yeah, we did something similar for whiskey, actually. The company is called Baxus, Baxus. And it allows you to trade high-end whiskeys and just help financialize that asset. We looked at something for high-end watches as well, which we didn't end up doing for unrelated reasons. But we're seeing more of these financializing of
trapped
dark
value.
Markets.
Trapped value, really.
Yeah, there's this trapped value. There's these dark markets that are illiquid. And if you can make them lit, transparent markets that are transparent, that people can go trade easily, then you can create a lot of value. You can unlock a lot of value. So that's a great use of this technology.
My view of the largest trap value on Earth is brand and culture. that's where I think the really big unlocks. What is Disney as a tokenized entity worth? If you have, tokens as part of its component parts, NFTs, what is that? What are these things when you tokenize culture and brand, which can't be done via equity under classic accounting? You can actually value these things. And we've seen a few people move this forward. It's not there yet, still too early, but I think there's trillions of dollars to come out of that.
I think that's what the meme coins are going to build towards. I think it's going to be a really weird journey. I think there's going to be lots of really strange things that happen between now and there. But meme coins to me are tokenized culture. Because what is meme coin speculation today? It's a Keynesian beauty contest. It's predicting what do you think other people will like. It's predicting culture.
Yeah, and predicting attention.
Exactly. And now, how exactly will this interplay from, like the pump.fun meme coins to a tokenized Disney? I don't actually know how we connect those dots yet. But, in the words of Steve Jobs, you can only connect the dots looking backwards. It's really impossible to connect them looking forward.
Listen, that was a perfect place to end as well, because it is never that easy, but you can see it. I mean, you've clearly articulated there is a path ahead. We don't know how that path goes, but that path is playing out. And our job as investors and participants is to kind of be involved in it, look for the opportunities, and enjoy the space growing.
Yeah, and maintain a long-term perspective. When you're feeling too emotionally close to the market, remember to zoom out.
How do you tell your investors that? Particularly in the liquid side, which is more volatile, because the others cheats because you don't have any mark to market in a VC really. But on the liquid side, how do you tell your investors, listen, we can give you some great returns if we get it right, but you will have to take some stomach churning volatility that is unlike any other asset on earth?
We show them our performance chart and we say, look, you can see the volatility, you know what you're buying. And we put the disclosures out there. And, I'm very grateful for the partners that we have that have been with us for a long time and ridden the volatility with us. The majority of our capital is from those, investors who've been with us for a long time. And they've been on the ride. They're not surprised anymore because they were with us through the worst times in 2022 and 2020 and 2018. They saw that, they experienced that, that stomach churning that I felt, they felt it too. And I think that really helps because now we have this strong group of really committed long-term investors that I can call and, talk about some of these questions openly because there's such a good trusted relationship.
Fantastic. Tushar, amazing to talk to you. Best of luck, and I'm sure we'll get you back on again at some point.
Thank you so much for having me. This was a blast.
Yeah, I loved it. Thank you. So I love these kind of conversations because I get to bounce my ideas around off great thinkers in the space and hear where they think this is all going. And I think within that, there's a lot of alpha in how we can position ourselves. Now, obviously, I've got the t-shirt on, don't fuck this up. The idea is we should not, as personal investors, really be going too far out the risk curve with a large part of our assets. We really should just buy and hold the core assets for the cycle. And those really are Bitcoin, Sol, and Ethereum. Now, there is other plays to be had. There will be a big play to be had from the next layer one narrative or whatever the latest narrative that catches on. And so feel free to try and capture those opportunities yourself. But remember, it's a very difficult space and you need to do a tremendous amount of research to find out what's really getting traction and what isn't. Anyway, best of luck out there. Hopefully you too won't fuck this up.
Make large crypto trades with Kraken OTC. Execute orders of more than 100,000 off the open exchange through our premium OTC trading service. Get 24/7 access to deep liquidity, minimal slippage, and competitive execution and settlement services. Private and secure trading options include chatting securely with our trade desk for a personalized high-touch service, or use our self-service RFQ for super fast, automated OTC trading. Non-investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. For more information, go to realvision.com/Kraken OTC.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.